Hi there. Thanks for tuning in. Today, we're going to be doing an analysis and valuation of AmBev. It's a Brazilian beer company. So, before I get into this analysis, I'm just going to say if you like these kinds of videos, if you want to see more stock analysis, please like and subscribe. There's videos coming out weekly and even more if there's enough demand for them. And if you have any stocks you want me to look at, please comment down below since I always love analyzing new companies and new prospects. Now, let's get started. So, AmBev is basically a brewing company that is part of Anheuser-Busch InBev, which is part of a even larger merger over there. So they're a subsidiary that's public. They're headquartered in Brazil, but they actually operate in a bunch of countries. So 18 countries, Canada, Brazil, Central America and the Caribbean, and then in South America, in the south of South America mainly. So this is important because they're a multinational company. They will be affected by currency fluctuations, but also they're a little diversified. So if the economy of one of these countries goes badly, well, maybe the others will help if they're doing well. However, their largest market here by far is Brazil, and then maybe followed by Canada and Argentina, of course. So, for the third quarter of 2024, which is the last quarter where we have data before the release of this video, their net revenue is up, their gross profit is up, their EBITDA is up. That's fantastic, right? And over the last 5 years, I mean, they've had these brands that we kind of know: Stella Artois, Corona, Budweiser, Brahma. I mean, these are very, very known brands that they are distributing and creating throughout Latin America and Canada. And they have some apps here that help them distribute it quicker. For example, Zé, which delivers drinks in Brazil. And they do have some value creation. So they do have a lot of positive free cash flow, 68 billion reais. They have an expansion of their ROIC. They have a dividend payout of 43 billion reais and a buyback of 2 billion. So that's fantastic. They are actually returning money to shareholders here, utilizing that positive free cash flow, a lot of it, to do that. So overall, as we see, their cash flow is growing. So their cash and cash equivalents have also grown from June to September, even from December to September. And even in 2023, we see generally this growth, but we do see that the exchange rate fluctuations can trim something down or up depending on what goes on. That's important to note. It's not critical right now, but you do see a Brazilian real which is affected. It has gone down by about 20% relative to the dollar. So that's something to note. Now, the version, the longer term picture here is one with a little bit of volatility, actually. Of course, near 2014, 2015, Brazil specifically was in an economic downturn that was very, very pronounced. And so you see this reflected here. 2016, 17, they go back to growth. And here, all the way to 2020, they were struggling. Now they're back up. They're doing pretty good from 2021, 22, 23. They're doing decent double-digit growth or high single digits. Now what's forecasted is actually to go down again. So it's important to note that this company does have cyclicalities and they can be pretty wide in general. The long-term trend is growth, right? But when you see it here, the 14 billion in revenue is very similar to the 16.2 billion in revenue that that they have now. So, yes, the long-term picture is a lot of growth, but it's not as much as you'd think because of this volatility and cyclicality. However, their gross margins are still pretty strong. They're around 50%, but notice that they have decreased actually. They used to be close to two-thirds, 66%. Now it's 50%. Their operating margins, 40% here. Now in 2023, 23.5%. I mean, this is a decrease in margins that's very important to note. Their return on invested capital, 23.6% versus 17.5%. So they were saying back here that ROIC is expanding. Yes, it expanded absolutely compared to 2020, 2021. I mean, it went back up to 17.5%. But look at where we were before. Even every metric basically was better before than it is right now. And that's a little worrying because, yes, you do have in general more earnings relative to the revenue, but the margins are a little worse. So if they have a very bad year with bad margins, they're going to see it worse than they did before. Now, another thing that's gonna actually inform my forecast is the expected growth for Brazil. So the Brazilian GDP is expected to grow by 2.8% in 2024 and 2.2% in 2025, and then converge to 2.3% in the medium term. This is from the World Bank. So I'm going to use this a little bit to just do my long-term predictions here. I'm just going to round up this 2.8% to 3%. Let's just say AmBev operates a little better than the Brazilian economy. Of course, no company is going to grow exactly like the economy grows, but you can use it to sort of give you an idea. Now, I want to do a valuation model for this. So what I'm going to do is this GDP number that we were talking about, which was 2.8 to 2.7%. We are going to grab that and use that as our perpetual growth rate here. So 3% perpetual growth rate. It's going to grow like that forever, basically. Now, for the years 2024 and 2025, I'm going to say that free cash flow is going to be reduced by quite a lot, actually. It's about by 17% in 2024, which is in line with analyst estimates, and then by a little more in 2025, another 3%. And then from 2026 onwards, I'm growing this by 3%. My required rate of return here is going to be 12.5%. Usually I use 11%. That's just my own criteria for US or some European stocks. Now, the difference here is I'm adding that extra 1.5% required rate of return to account for country risk, for currency risk, because they operate mainly in emerging markets. You have two options here when you do a valuation model. One of them is to increase your required rate of return. The other is to keep it the same, but then add a margin of safety later on. So what I'm choosing here is to just increase my required rate of return. Now, if we grab these projected free cash flow numbers with that required rate of return, perpetual growth rate, and divided by the total number of shares out, with my discounted cash flow model, you get a fair value of equity of $1.77. Now, if you add the net cash that they have actually, negative net debt, which is net cash, which is nice, they have practically no debt, then you actually get a value post debt of $1.97. Let's compare this with where AmBev is right now. And wow, it's at $1.79. I mean, it was practically here, if not a little closer to it's closer to the model with no debt, which actually could reflect the truth because it's not like company is solely what they have in cash or in debt. It's more so what they generate. So, yeah, I mean, P ratio of 12, dividend yield of 6.06%, which is really nice, actually. I'm going to say that's a nice dividend yield. But the implications of it are interesting. And I mean, if you look at the last 5 years, wow, it's down by 60%. And even lately, it was trading over $2. Now it's down to this $1.80 level, and yet it doesn't seem undervalued to me. It seems like it's right here in the value. I mean, 1.97, I guess you could say it's about 10% undervalued. But is that enough? Is that truly enough for us to justify investing in it when the cash flow it generates and the projections, at least in the nearer term, with the currency fluctuations, with some weakness in Brazilian growth, is that enough to justify buying this? So, yeah, I mean, it looks okay, but not as great as you think. So let's assume it's fairly valued. Let's assume the stock just doesn't really go anywhere in terms of price, maybe goes up a tiny bit, but not that much. What you get in terms of returns is the dividend minus the tax that you pay on it. So the dividend is roughly 6%. It's maybe 5%, say you pay around a 20% tax on it. So your return goes from being a 6% to a 5%. This is why returning dividends is actually a little more inefficient than them just buying back a ton of shares and then bringing the stock price up through that. And that's also why the dividend is a double-edged sword because they have a ton of free cash flow. They had about 68 billion reais, but 43 billion of that is then going to the dividend. So you see how the utilization of the cash flow is very interesting because they're almost tied up in that because it looks very bad if you cut the dividend. So then they have less flexibility to buy back shares or reinvest in the business or grow, do an acquisition, etc. And growth in Brazil looks waning, and the real is not in the greatest situation compared to the dollar. However, they could still surprise. I mean, absolutely, they could decline by less than analysts expect. They could grow stratospherically, and so the stock could just jump back up with an earnings surprise. However, if you're banking on an earnings surprise, that means that you're actually taking a greater risk for a potentially great reward. So this would be a high risk, high reward investment because it's not like it's fundamentally undervalued because of what it produces or looks like it could keep producing. It's more of like if they surprise us or if some fundamental trends in the micro or macro side are different than what we expect. That makes it risky. And that's where we ask what would make the valuation rise? In the case of the stock, it would be something like a surprise or would be way more return to investors than what they're telling you, which is not as likely. So, this kind of investment is inherently a little riskier for that reason. It's interesting. I mean, I'll keep tracking it for sure, but just because the stock has gone down a bunch doesn't make it cheap necessarily. In fact, it looks about fairly valued right now, and I think it's a great example of that. Now, thank you so much for watching. If you made it to the end, don't forget to like and subscribe. And thank you so much for watching. Have a great rest of your day.